Many of us will be keeping an eye on events in the Middle East on humanitarian grounds, or for fear that the conflict spreads and drags in other nations, or on financial grounds, as prior periods of conflict and instability there have had a huge effect upon the price of oil and, more recently, gas. The 1970s were a classic example, as oil spiked after the Yom Kippur War of 1973 and again after the fall of the Shah of Iran in 1979, with the result that inflation bedeviled the decade. Bonds and cash were pretty poor performers, equities struggled in real terms, and commodities, notably gold, were the place to be back then. No one knows if history will repeat itself, and over the past year, oil and gas prices have been subdued. Even allowing for the occasional spike here and there, both are down by 1/5 over the past 12 months. This will please central bankers no end, as lower fuel and energy prices are helping to cool inflation and give them room for interest rate cuts, and it cuts consumers a little bit of slack as well. It's less good, of course, for oil and gas producers and shareholders in them. BP shares are down by more than a quarter, and Shell's by around 10% in the past year. In fact, BP is the worst performing stock among all of the global oil majors. The sudden departure of former boss Bernard Looney last autumn may not have helped here, but equally nor may Mr. Looney's strategy of placing a greater emphasis upon growing energy output from renewable sources and shrinking hydrocarbon production, at least at a time when oil and gas prices were looking pretty strong. To the likely despair of environmental campaigners, BP seems to have been penalised for its determination to press ahead with this strategy. Now, when he took the reins, Murray Auchincloss, Mr. Looney's successor, stuck to BP's plan of reducing hydrocarbon output by a quarter by 2030, but that itself was a step back from a targeted initial 40% cut. Now, reports have since suggested a further shift amid investment in new oil and gas fields in the Middle East and Gulf of Mexico to place a fresh emphasis on hydrocarbons, although the company is yet to confirm this. Either way, this all makes the timing of the third quarter results from both BP and Shell particularly interesting. BP is due on the 29th of October, Shell on the 31st. Both firms put out a trading update early this month, and neither commentary provided much by way of incremental good news, given the backdrop of weaker oil and gas prices. BP flagged lower oil and gas production, weaker refining margins, lower income from its oil trading operations, and higher net debt, as well as the impact of weaker hydrocarbon prices for the third quarter compared to the second. Shell increased its forecast for hydrocarbon production from its upstream operations, but warned that refining margins and profits from its chemicals and refined products or downstream businesses will be down compared to the previous quarter. At least that should at least serve to lower expectations for the quarterly results, where analysts and shareholders will look to 5 key sets of figures. The first is the headline profit, where, admittedly, there are many different benchmarks on offer, from earnings before interest, taxes, depreciation and amortization, or EBITDA, to pre-tax profit, to net profit, as well as adjusted EBITDA, current cost of supply or CCS or replacement cost profit, or even adjusted or underlying CCS or replacement cost profit. For better or worse, BP tends to focus on replacement cost and underlying replacement cost profit, and Shell on EBITDA and adjusted EBITDA. So we'll focus our attentions here, at least for ease of comparability, if nothing else. At BP, the company recorded an underlying replacement cost profit of $2.8 billion in the second quarter, and that's our benchmark for the third, along with a $3.3 billion figure for the July to September period 1 year ago. Shell generated $16.8 billion in adjusted EBITDA in the second quarter, down from the first 3 months of the year. And in the third quarter of last year, the oil major generated $16.3 billion in adjusted EBITDA. Analysts will then look to the mix of profits. In the second quarter, BP's oil production arm generated $3.1 billion, gas $1.4 billion, and the downstream customers and products operation $1.1 billion. At Shell, gas was again a bigger earner than oil production in the second quarter. Attention will then switch to capital expenditure and cash flow, as well as any acquisitions and disposals. BP continues to budget for $16 billion in capex this year, a big drop from last year, while Shell is targeting between $22 and $25 billion for 2024, and that's way down from the $40 billion peak of 2013. After that, analysts and shareholders will look at the balance sheet, where higher profits, lower capex and disposals have seen both Shell and BP substantially reduce their net borrowings. At the end of Q2, BP's net debt was $21 billion and Shell's $37 billion. This is all important because healthy cash flow and healthy balance sheets can facilitate cash returns to shareholders. Both companies are rebuilding their dividends after the cuts of 2020. BP's quarterly dividend is back to 8 US cents a quarter from its peak of 10.5, and Shell's to 34.4 US cents a quarter from a high of 47. Finally, both firms are also running share buybacks. BP at a run rate of $1.75 billion a quarter, while Shell ran a $4 billion scheme in the second period. If, and I stress if, the current run rates for dividends and buybacks are maintained, BP will return $12 billion to its investors in 2024 and Shell $21 billion. That's 14% and 10% of their stock market capitalizations respectively as I sit here. Thank you for watching.